In May of 2020, FreightWaves Live is headed back to the largest freight market in the Southeast, Atlanta, Georgia. Join FreightWaves for our best event yet, featuring captivating keynote speakers and rapid-fire demos of technology that is sure to take our industry to the next level. This is your opportunity to interact with some of the most innovative leaders as we mark a new decade in transportation. See you in Atlanta May 5th and 6th.
Hello and welcome to this Wednesday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up we have Luke Falasca talking to the brokers. We have the man himself, John Kingston, here for an oil update, but first a word from Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your carrier update presented by our friends at PowerFleet. So the market is in a holding pattern. I know that's not that exciting. 7.57% tender rejection rate right now in the United States. But if you look up here, I've pulled up some nice little gauges here. I don't use these that often, but I think that they're great to show point of reference if you're not familiar necessarily with what a 16.87 tender rejection rate is, for instance, for the reefer outbound tender rejection index. So it's slightly above where we say the midpoint is for the rejection rates for the last 52 weeks. That means that reefer rates should be a little bit higher than average for the year. 16.87 as compared to 24.38 at their peak at some point during the year. The rest of the country still right on par with where we'd expect it to be in terms of, not necessarily at the midpoint, but a little below that. January, we tend to see this declining activity, rejection rates coming down throughout the month, through February, for instance, but we are showing some signs of flatness. So what does that mean necessarily? Well, last year, we had a declining tender rejection rate coming out of the Martin Luther King holiday through the 23rd of January. So we do expect that here in the next few days that this rate will start to decline a little bit further entering the month, ending the month, I should say, coming through into February, where it will flatten out again. So a flat tender rejection rate, not necessarily that unexpected during this time, so don't get too excited just yet in terms of, is this the great capacity rebound? Although we do think that there will be some of that this year, maybe not in the first quarter, however. So looking at the country itself, so van tender rejection rates down around 6.97%. Reefer rejection rates starting to fall back after having a nice little bump there here in the middle part of the month. As we talked about just a second ago, the reefer rejection rates are a little bit stronger than the van rejection rates at this point in time. So capacity for reefer carriers right now, a little bit tighter, should have a little bit more success. Mobile, Alabama leading the outbound reject volatility charge right now. So we talked about Mobile yesterday, still showing a lot of tightness in the Mobile market across the Gulf Coast. So the southern states in general are showing some increasing tightness. And I'm going to dive into that here in just a second. But nationwide, you're looking at tweeners leading the charge in terms of the tightest areas, the tightest loads that are going across the country right now. Mid-haul coming in second, long haul in third in terms of the highest reefer or rejection rate, I should say. Looking at the weighted rejection index across the country, let's see where the most relevant markets versus this time last week are. So you can see this big dark glob here in the south. You've got Mobile down here, New Orleans, Birmingham, Montgomery, all this Nashville, all the way south to the Gulf Coast, showing dark blue right there in the middle part of the south. So what does that mean? Carriers should have an increasing opportunity here, a lot more than normal. Let's dive into where we're seeing on this list here. So New Orleans, Louisiana leads the charge, 7.38 weighted rejection index. Anything over a 5 typically means that's a significant opportunity. Anything from 5 to, and higher, or -5 and lower, means that things are moving pretty significantly. Definitely pay attention to those. Mobile, Alabama, as we talked about. Rock Island, Illinois, if you're looking into the Midwest there, down around that military base and whatever. Nashville, Tennessee, also on the list. So let's pull up the Nashville, Tennessee market here. So we're seeing a pretty strong increase in tender rejection rates, and it is not reefer, it is van, 8.37% in terms of rejection rates. A big, strong upward push here to start to close out the month. We haven't seen this rate since we were falling out of that Christmas, New Year's type of tightness. So Anybody that's operating around, in and around Nashville over the next few days should look at the spot market and see if there's any increasing opportunities, especially if you've got a load finaling there over the next few days. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi everyone, I'm Luke and I'm bringing you another broker update. And you may have noticed over the last few days we've been in a fairly flat market and not much has changed. If we look at the chart behind me here, the blue line is outbound tender rejections. Fairly flat, not exciting. That doesn't mean there aren't areas of opportunity in a flat market, which we'll get to later. Now, the one thing I do want to draw your attention to is this green line here. That is our outbound volume index here in the United States. And you'll notice it's starting to dip down. That's not something we like to see, as that would indicate that there are less opportunities or less freight to move on a daily basis. So if you are losing some volume from some of your shippers, that could be why. However, there are some good opportunities. We're going to go to the call map here and figure out what that is. So let's take a look here. Remember, areas in green are areas of growth, meaning weekly change, so weekly increase in outbound volume. So if you're looking for areas of opportunities to call on, whether from current customers or just looking for areas to gather new customers, focus some of your calls today on some of these green markets. A lot of green down in Texas, as well as a little bit here kind of in the Pacific Northwest region, mainly Idaho, Montana, and a little bit in Washington. So focus on some of those areas. Also kind of down here in the middle of the country as well. So if you're looking for areas to call today, those are the areas I would focus on. Now, the market that we're going to watch today is actually going to be Raleigh, North Carolina. So Raleigh here, if you notice on this chart, we've got the dry van tender rejection percentage, okay? That is in blue. So the blue here is indicating there we had this big spike after the holiday and we kind of hit bottom around 10%, and we're slowly starting to increase and push up. So that's a good sign. So if you're moving freight out of the Raleigh market today, be sure to increase your spot market bids a little bit from where you did yesterday to help protect yourself, as carriers may ask for a little bit of a premium in that market. Now on the flip side, we've got one of the highest lanes out of Raleigh, North Carolina for dry vans today is from Raleigh to Fort Wayne, Indiana. All right, not a massive market that you're going to, but it is a market that's seeing some growth right now in a flat market. So a great opportunity to make a little extra money. So you see, that's this green line here. And you'll notice that green line is starting to tick up. We're sitting at almost 14.5% rejections. That's a really, really good sign. So if you're moving freight on that lane today, be sure to up your bids on the spot market to create margins, all right? And hopefully you can make a little extra money here in the middle of the week. Now, taking a look here at our rate forecasting calculator to my left, you're going to see this is that same lane. So right now we're sitting about $1.46 a mile. We'll be looking at the median price point today. That is your line haul rate. So you have to add in your fuel surcharge to get your all-in rate. But if you notice, it's going to be fairly level here for the next about a month out. We're not predicting much change there in terms of rates. However, as we go to that 3-month mark, it looks like there will be some downward pressure on pricing as we move out. So that's a good sign. So there might be a little bit of not a whole lot of change right now, but as we go out, downward pressure. So when you look to move freight on this lane, I wouldn't lock in. I might think about locking in a contract for a shipper right now, as you might potentially be paying a little bit less towards the end of the quarter. All right, I'm Luke. That'll do it for your broker update for today.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the Freight Tech Revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
I'm John Kingston, and it's time for our oil update. Diesel prices have been coming down, but by some standards, they're really not coming down enough. The DOE price that came out yesterday afternoon, Wednesday afternoon, it was delayed a little bit because of the Martin Luther King holiday, was only down about 2.7 cents. Now, here is the rack price. This is the wholesale price over the past couple of weeks. You can see that it's dropped actually more like 15 to 20 cents. The DOE number is not catching that. So that sets up a pretty nice situation for carriers because they're getting paid that higher fuel surcharge. Meanwhile, they're buying at these lower prices. This is a pretty nice spread. Over time, that does tend to even out. So it's a short-term windfall. It's not kind of a permanent state, but that's the way it goes. I'm a little surprised that the DOE number that came out yesterday failed to capture a lot of this. And you see this also in the retail price. This is the DTS series that we have in SONAR. You can see how much the price of diesel has fallen over the past couple of weeks. It's really nowhere near like the fall in the price of the commodity number on the CME. The ultra low sulfur diesel price is down about 20 cents since the start of the year. We'll probably talk tomorrow a little bit about some of the reasons for that. Basically, the world's got a lot of diesel right now, a lot of diesel inventories. The U.S. distillate inventory numbers have been rising significantly. They'll come out again today on Thursday. We'll see how much they built, but that's been a real reason. But I think right now, the more important story for the market is the Chinese virus, the Chinese coronavirus. And why is that? People have long memories. And in the SARS crisis in 2003, international jet fuel demand dropped about 1.5%. That doesn't sound like a lot, but in a balanced market, if you suddenly get a shift of 1.5% on the supplier demand side, that is significant. Well, what happened back then? The price of jet fuel collapsed. Why does that matter to diesel? Because jet is a distillate, diesel is a distillate. You cannot have a fall in the price of jet and the price of diesel hold steady. So what you saw yesterday in the market on the CME, where the ultra low sulfur diesel contract is traded, is that it plummeted. It was down about 1.7%, while the crude market was down about 0.7%. Everybody said there was really only one reason for this big difference in decline, and that was the fears of the jet fuel market collapsing as a result of the virus, possibly affecting international travel. So you really have to keep your eye on that. It could be this sort of unexpected and really unwanted side benefit to truck drivers that they get lower diesel prices as a result of a Chinese virus. We certainly don't want that in any way, shape, or form, but really it's out there, and jet travel is very dependent upon this kind of a fear, and so we're going to keep our eye on that. One last thing I want to mention that happened yesterday is that Phillips 66 and a partner, Renewable Energy, decided to cancel plans to build a renewable diesel plant near the Phillips 66 refinery in Ferndale, Washington. In terms of supply, this really wasn't a big amount of supply. It was around maybe 13,000 barrels a day, though it's a renewable fuel. No plants are all that big, but it's very disturbing because Phillips 66 said, you know what, we did it because the permits were starting to get delayed. We were looking at a longer timeline to build it and operate it as a result of these delays, so we're going to pull back. The world keeps talking about going to sort of a net carbon neutral by 2050, and here was this one little plant that produces a diesel fuel that certainly is less carbon intensive than the diesel that you're putting in your trucks now, and they couldn't get it done. So what does that say about the possibility of building the massive infrastructure that the world might need to think it's going to be carbon neutral by 2050? I don't think it's very good. That's why I think it's a discouraging moment. I'm John Kingston talking about oil. Thanks for joining us.
And that's going to do it for this Wednesday edition of FreightWaves Now. The content doesn't stop here. We're always posting around the clock, so check us out on all your favorite social media sites as well. And we have our FreightWaves TV app, so check us out on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.